Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about the Trade Desk. So, the Trade Desk is a company that has been and continues to be very much in investor favor. And even though many of its peers have sold off in the past several months, the Trade Desk has actually kept and held its ground quite significantly. With that in mind, new investors coming into the stock are having to pay approximately 23 times this year's revenues, which probably isn't the most attractive entry point for new investors to the stock. I'm not talking about the investors that have already held the stock, those are fully committed, entrenched, and all that. But for new investors coming to the stock, are kind of paying this kind of multiple is probably not that attractive. But on the other side of the equation, this is a very high quality company and it's a leader in the space, a founder led business. So with high margins, and there's a lot here to kind of think about, that can justify the high multiple. So kind of highlighted some of the companies here. So you can see in the screen, the Trade Desk actually held its ground, up 7% in the past 6 months, compared with many of its peers like Magnite, Pubmatic, Tremor, have all dramatically sold off. And there are kind of good reasons for that, and there's kind of a bit an overreaction, but all in all, it's kind of, you have to think about this, right? So anyone that's kind of in ad tech in the last several months, aside from the traders, somewhere between exasperated and frustrated. And if you're probably a Magnite shareholder, you probably would have already capitulated to kind of, game over. You're not even interested in this space anymore. Um, and I mean, if you think about it, right? So when you look at the traders, as the business is rapidly growing, the guidance for Q4 is growing to approximately 22% year-over-year growth rates. Now, think about this. In Q4 of last year, there was the political ad spend that kind of added a bump there. But if you take that out and normalize it for year-over-year, the Q4 guidance for this year is pointing to approximately 35% year-over-year growth rates. Now, if you think about it, right, the business is kind of reaching approximately 1.5 billion in revenues, okay? And to be growing at close to 30% compounded annual growth rate is pretty tough it's a pretty tough bar to cross. So it is a tough bar. They are doing it, and there's plenty of reasons here to kind of think that this is not going to soon slow down anytime soon. So this came out yesterday, and it's a Nielsen report, and you can see here. So broadcasters as a whole still own approximately a quarter of the viewing time in TV from TV audiences. So it's still being held up to a large extent by the sporting channels and sporting broadcasters, and slowly certain companies, like Fubu or to other companies slightly bigger like Apple and Amazon, are kind of trying to chip away at that and kind of buy odd bits of licenses from sporting companies. And the more and more that sporting goes away from the broadcasters to streaming platforms, there's less and less reason for viewers to remain attached to to linear TV. And if the sports move away, then why would you even pay for linear TV? And that's why there's so much of the cord shaving and cord cutting happening in the background. So I'm not going to say that it's going to happen overnight, but it's just another element to think about why you wouldn't want to be attached to linear TV. Now, everything that I've said, has been, everyone knows this stuff already, and having to pay 23 times revenues for the Trade Desk is kind of like, okay, it's absolutely not in the bargain basement, and it'd be, disingenuous to say that it is. But it is kind of a reasonable valuation if you think about this being one of the leading companies in ad tech and getting a lot of the ad tech dollars away from the walled gardens, which is Alphabet, Meta, and Amazon. So once you take away those, the Trade Desk really punches above its weight. And it's, I haven't discussed it right today, but it's a business that has 30% EBITDA margin, so it's something that's very, very, very highly profitable. It also, you could make the argument is the way that they kind of report their revenues as net revenues rather than gross revenues. But for all intents and purposes, this is a very strong free cash flow generating business. On the other side of the equation, you kind of think about, okay, so if let's say that the Trade Desk grows approximately 25 to 30% compounded annual growth rates, and if you compare to some of its peers, there are many of them that have now priced at, let's say, 6 times forward sales or even 1 times forward sales in the case of per annum. So why would you pay for 23 times forward sales for the Trade Desk in that light? Now, in invest, there's a lot of ways to kind of think about it, right? So you can be a short-term investor, kind of looking for just like small pops here and there, or you can be a multi-year compounder investment sort of person. Now, it doesn't really matter what type of investor you are. What matters is that you know what type of investor you are. And everyone is a buy and hold investor while the share price is going up. But when you need to know what you are, because if you're paying 23 times forward sales and you're asking new investors to come and pay 23 times forward sales, you kind of think to yourself, okay, if this meaningfully sells off as the rest of the ad tech space, will I be able to have the conviction in myself to hold on strong? And obviously, I don't know that for you, but it's kind of like you have to think about it from the new shareholder. And when they come in, they have to see that there's enough of an upside here because there are so many high quality disruptive companies in ad tech that are priced, like I said already, so much cheaper than that, also generating ample free cash flow with strong opportunities as well. And I personally cannot see myself deploying any capital here. So, but if you want to find out some of the names that I'm picking out right now that are really attractive, don't forget to check out my marketplace. It's called Deep Value Returns. You can see the reviews on Seeking Alpha, what people have said.